If any part of your retirement savings sits in a target date fund or a broad index fund, you already own a piece of a machine that can lose you money before any human involved even knows why. That machine is not a person making a judgment call about a company's future. It is code, running across dozens of trading firms at once, reading headlines faster than you could read this sentence. It does not wait for a story to be confirmed before it acts. It trades first, and it asks questions never. You have never met the system that decides what your account is worth in the next 5 minutes, and it has never once asked your permission. In February of 2023, Google's parent company Alphabet unveiled a new chatbot called Bard, built to answer the sudden popularity of ChatGPT. In the promotional clip Google posted to introduce it, Bard was asked about discoveries from the James Webb Space Telescope, and it answered with a claim that was simply false. The error was small. One wrong sentence about a telescope in a video that had not even reached the public yet. Within hours, Alphabet's stock fell as much as 9%, and the company lost close to $100 billion in market value, with some reports putting the full one-day swing nearer to $160 billion. The easy story is that investors panicked because Google looked incompetent next to its rivals, at the exact moment the world was deciding who would lead in artificial intelligence. That story feels reasonable on its face. A company built on being the correct answer to every question got caught giving a wrong one, in public, on camera, during the 1 week reputation mattered most. But hold that story next to the size of the reaction. One inaccurate sentence about a telescope erased more value in an afternoon than most entire industries are worth. That is not a company being repriced because its business changed. That is something else. And it is still running underneath every stock you own right now. This is not the first time markets have moved this way, and it will not be the last. In 2013, a hacked social media account posted a handful of false words, and inside 2 minutes, the broader stock market lost more value than Alphabet did on the day Bard made its mistake. Nothing had actually happened. The market did not know that yet. By the time anyone found out, the damage was already priced in. That event is the blueprint for what happened to Google. It is also the blueprint for what happens to your account the next time a headline turns out to be wrong before anyone has time to check. The mechanism at work here has a name inside trading firms. It is called sentiment-driven repricing, and it means the market now prices a story before it prices the facts underneath that story. Think of a city that draws its entire water supply through a single valve. Nobody has to inspect the water to decide whether to shut that valve. They only have to watch the pressure gauge move. If the gauge drops, the valve closes automatically, instantly, before anyone walks out to check whether the pipe actually broke. Modern markets run on the same logic. The pressure gauge is language. The valve is a sell order, and it closes in milliseconds. Step 1. A piece of language enters the system. A headline, a demo clip, a tweet, and software scores it for sentiment before any person has finished reading it. That scoring happens in a fraction of a second, and the software does not know whether the underlying claim is true. It only knows whether the words sound bad. Step 2. Once that sentiment score crosses a threshold, trading algorithms at multiple firms fire sell orders automatically because they were built to move first and verify later. This happens across many firms in the same instant, so the selling does not trickle in. It arrives all at once in the same handful of seconds. Step 3. The falling price becomes its own evidence. Other systems, watching price instead of words, read the drop itself as confirmation that something is genuinely wrong, and they sell too. By the time a human researcher finishes reading the actual claim, the damage has already been priced in twice. In Alphabet's case, that entire sequence ran inside a single trading session on a stock that typically moves 1 or 2% on an ordinary day. 9% in hours, triggered by one factual error inside a video that had not shipped to a single customer. Search revenue, cloud contracts, advertising demand, none of it changed that day. Only the story changed, and the story was enough. This is the identical sequence that hit the wider market in 2013, when a fabricated claim of an explosion triggered algorithms across the market to sell in unison, wiping out roughly $136 billion in about 2 minutes before a single news organization had confirmed anything. The market recovered within minutes once the tweet was proven false. Google's stock took longer to recover because the doubt it triggered, can this company still lead in artificial intelligence, could not be resolved as quickly as a hoax could be deleted. Same trigger. Different clock speed. The three-step sequence explains how the money moves. It does not explain why the market has decided a single unverified sentence is worth more in the moment than a balance sheet built over 20 years. That question is where the real risk lives. On April 23, 2013, at 1:17 in the afternoon, the Associated Press's Twitter account posted 3 false words: explosions, White House, president, injured. The account had been compromised hours earlier through a phishing email sent to newsroom staff. The tweet stayed visible for only a few minutes before AP caught it and deleted it. By then, it no longer mattered whether it was deleted. The damage does not wait for corrections. At the time, most financial commentary treated this as a curiosity, a strange glitch in an otherwise rational system. Cable news called it a hack. Regulators called it a lesson in cybersecurity. The prevailing belief was that markets are priced by analysts, studying earnings, reading filings, forecasting cash flow, and that a single false tweet could only cause a brief, shallow wobble before rational buyers stepped back in. That belief was comforting. It was also incomplete. What was actually happening underneath the wobble was a market structure that had quietly changed years earlier. By 2013, an enormous share of daily trading volume was already executed by algorithms scanning news feeds and social media for sentiment, not by humans reading annual reports. Those systems did not distinguish between a verified Reuters headline and a hacked tweet from a compromised account. Language was language. A negative score triggered a sell order regardless of the source. And once enough of those orders fired within the same few seconds, the selling itself became the signal the rest of the system reacted to. The outcome, once the tweet was confirmed false, was a full recovery within about 3 minutes, but not before roughly $136 billion in market value had briefly vanished and reappeared. Nobody who sold at the bottom of that 2-minute window got their money back at the same price. Some pension systems and index funds, rebalancing automatically on a schedule, executed trades inside that exact window without any person choosing to. The mistake cost real money to real accounts that never saw the tweet at all. The parallel is not perfect, and it should not be forced to be. The 2013 event reversed in minutes because the falsehood was obvious and easy to disprove. Alphabet's decline in 2023 took longer to stabilize because the underlying question, whether Google had fallen behind in artificial intelligence, was not something a single correction could resolve. One was a hoax with a clean answer. The other was a genuine doubt with no clean answer, which is why the price took weeks, not minutes, to find its footing again. The asset was different. The mechanism was the same. Every dollar sitting in a passively managed retirement account today moves through the same sentiment scoring infrastructure that mispriced the market in 2013 and mispriced Alphabet in 2023. That infrastructure has only grown larger and faster in the years since, not smaller. It now sits underneath a stock market carrying more concentrated bets on artificial intelligence than at any point in market history. The historical record does not promise this happens again on any particular day to any particular company. Patterns are not guarantees, and markets have absorbed sentiment shocks before without lasting damage. What the record does show consistently across 2 events more than a decade apart is that the size of a market reaction and the size of the underlying problem have stopped needing to match. A telescope claim moved $100 billion. A hacked tweet moved $136 billion. Neither number reflected a change in what any of these companies actually did the next day. Right now, a handful of AI-related companies make up a larger share of major stock indexes than at almost any point on record, which means the sentiment scoring machinery described here is no longer pricing a handful of speculative names. It is pricing the core of most retirement accounts in the country. The next headline that moves this fast does not need to be true. It only needs to be believable for the few seconds it takes the algorithms to react, and by the time it is corrected, the trade has already happened, on your behalf, without your input. So the number that flashes on a screen after an afternoon like that is not really a measurement of what a company is worth. It is a measurement of how fast a story traveled through a system built to react before it verifies. The next time a headline about an AI company drops your account value in an afternoon, the question worth asking is not whether the company failed. It is whether anything actually happened at all, or whether a valve just closed somewhere on a signal nobody checked. The mechanism does not care whether you understand it, it runs either way.